Nicholas Sorour, Portfolio Manager at Sasfin Securities, joins us as we look at the day's numbers. Highlights for you so far, Nicholas?
Well, David, the biggest highlight today was, of course, the market reaction to the unexpected decrease in interest rates in China. I mean, this is something that hasn't happened since 2008, a good 4 years. So, you know, I saw that ticker just zoom all the way up by about 200 points. There was a bit of short covering with some traders getting a bit scared about that. And the markets managed to hang on to most of their gains. So there was a little bit of a pullback in late afternoon trade. You know, Fed Chairman Brett Bernanke started to chat around about 4. Easing, more quantitative easing, more loosening of policy there and so on. You know, a loosening of policy will be very beneficial for the markets. He didn't mention anything specific, so the markets didn't continue their rise, a slight pullback at the moment, but generally everything in the green, a pretty positive day. Sentiment seems to be turning for the better at the moment.
We've certainly had two strong days in the East, followed through in Europe, quite big increases. Now we look at the gold counters. You know, yesterday 3 or 4 of them were up by 3 to 4% and now down. How does that tie in with what you've just said?
Well, what it ties in with essentially is the risk on, risk off trade. So what we have is we have a stronger South African currency because the American currency is not as strong as it was 2 days ago. So we've got the rand a little bit stronger. Then we've got the gold price a little bit weaker because people aren't as concerned about the world economy at the moment, hence a little bit of a selling pressure on the rand. On the gold price. So that affects the gold shares that we have because it's a direct translation. And again, a bit of profit taking. So that's really all it was. It's one of those trading tools that people use sometimes.
Looking at a couple of the other shares that we've had today, Naspers up 3.38%. I mean, it is the big gorilla in the South African media space now with its exposure to China. Would that have had a link up at all with that Chinese rate cut? Possibly.
I mean, Naspers has had a bit of a rough ride. I mean, indirectly, they own a few percentage points of Facebook, and Facebook has had a terrible listing. And we saw the run up to the Facebook listing. Naspers share price run up incredibly strongly. Then the price listed and it wasn't so good. Price pulled back again. And I think people are realizing that, you know, it wasn't as bad as they thought. It's a few percentage points. Again, Naspers might be looking good at the moment, so a little bit of buying happening at the moment. Nothing specific, I would say.
Other stocks that have caught your eye in the last day or two?
Well, Anglo-American, obviously, I watched like a hawk. You know, that up quite strongly today, above some key technical levels. So that's something that I've considered. Vodacom's another one that I've been looking at as well. It's getting close to, you know, going ex-dividend, a nice dividend there. Share price has come off about 10%. So that's something that I'm keeping.
Down 2% yesterday, I think.
Absolutely, to 98 Rand, up a little bit today. I think maybe close to 98 Rand 70 thereabouts. So that's something I've been keeping my eyes firmly on. But generally speaking, you know, the ebb and flow of this market. I mean, last week or even we were at 32,800. Now we got up to 33,800, 1,000-point swing in a matter of a week. It's not frightening. It's just amazingly volatile at the end of the day. You know, it's 2 days positive, 2 days negative, so on. So it's a little bit difficult at the moment.
Rather like the currency has been.
Absolutely, it's very difficult to predict. It's like pick a number. Where's it going to go to? But yeah, no, absolutely.
It's almost like people are taken a little aback because things have been jogging along for a long time because people aren't sure what's going to happen. So you're not selling, you're not buying, you're just waiting.
There's a lot of money on the sidelines. I mean, don't get me wrong, that there's no disputing that. And I think what we have to understand is that when is the correct time to get in, when is the correct time to get in. And it all depends on what your risk is at the end of the day. I mean, if you're a long-term investor and you're willing to ride this thing out for the next 10, 20 years, it doesn't really matter where you buy, as long as you're buying a good, solid company. But if you're a trader and you're very concerned about the day-to-day movements, it's almost impossible to judge. And I think that's really what it comes down to at the end of the day.
If you look at the big diversified miners, you mentioned Anglo, it's up 4.36, that's 1.61%. BHP Billiton also up. And the point has been made that these are companies that are trading at quite low PE levels, that they are big companies, they do lots of things, they make things or mine things that people want. In terms of long-term value, these are looking cheap.
That is one side of the coin, you know, which you can certainly agree with. The other side is that they're pricing in a lot of risk. You know, there are many, many unknowns in Europe, and we don't really understand how that is going to affect world growth and world GDP. And that is exactly connected to where you see these resource share prices going. Of course, China is another big issue. I mean, you need to understand Rio Tinto and BHP Billiton, you know, their biggest customer is China. I mean, we're talking about 30% in the one case and 28% in the other. If you're going to see a slowdown there, That's your biggest customer slowing down in their consumption of raw materials. The other side of the coin is you had China that came out today saying that they're going to increase expenditure on producing more steel production by $23 billion. You know, that is a huge amount, which means there's going to be more demand for coking coal and more demand for iron ore, which happens to be some of the biggest commodity producers, you know, in Rio Tinto and BHP Billiton. So it's a difficult concept at the end of the day. I think you need to have a balance. I mean, personally, I would say you need to have a diversified miner in your portfolio. It is cheap at the moment, but there's a lot of risk that comes with it, and you need to understand that. But generally speaking, it is looking cheap at the moment.
Which of the two would you go for? You
I
said
would
you
go
watch
for
Anglo like a hawk.
I do. I think Anglo is a great trading tool to have. You know, you could argue in perpetuity which one's the better one. I personally feel that from a risk perspective, BHP Billiton would be the better stock to go for. It's more diversified. You can argue it's got a better management team, and there's less debt. Whereas Anglo American is by far the cheapest in valuation. It's got the biggest potential for further upside in capital. So it depends on what your risk is at the end of the day.
The retail sector, that's one of the ones which people have said have run hard, and there are lots of lovely shares to own, but they're too expensive at the moment. The other factor there is that foreign investors have driven up those shares, substantial holdings by foreign investors.
I mean, the foreign shareholding of Mr. Price, Massmart, Clicks and so on, if you look at the numbers, some of them are quite frightening. I think in Massmart's case, obviously we know that Walmart owns 50%, but if you add all the other foreign shareholders, you're up to 80% holding of that company. And that has pushed up, you know, the prices tremendously. But there's also two sides to this. The one side says that, look, the valuations are overdone at the moment. They're blowing their bolt currently. It's very little upside left. And the reason for that is they believe that the market at the moment is saturated. The other side of the coin says, well, all these companies are expanding into Africa. You know, you've got great potential in Mozambique, great potential in our other sub-Saharan countries, and you're seeing a lot of potential growth coming from there, you know, and that's where they're placing their bets at the moment and potentially seeing more upside. Again, back at home, people are saying that the market isn't saturated. There's a lot of consumerism in South Africa currently, and it's really just touching the tip at the moment. There's plenty more, you know. It's difficult, you know, you can't...
if it was easy, we wouldn't have to sit here and talk about it. You wouldn't be sitting here. But there are mixed signals all the time, and people are looking all the time. It's a time when people are looking, they place a great deal of emphasis on a slightly optimistic or a slightly pessimistic
I think where's the value? Where do you hide? You know, you have to look at three scenarios. All right, you look at the scenario of, is Europe going to blow up? Is it going to be the end, you know? And if it is, there will still be shares out there that would certainly be worthwhile having on your portfolio. People will still smoke, people will still consume alcohol, British American tobacco, South African breweries, believe it or not. Yep. And the rich remain rich during these periods, so, you know, Richemont is certainly something to consider as well, okay? But that might not happen. You know, Europe might sort out their problems, and they can if they actually agree on something. There's just a lot of talk at the moment. But don't get me wrong, once there's a conclusive agreement on how to sort out the European issue, there is just so much money out there waiting to come into the market that before you know it, this market is going to fly. And if you're not in it, you're going to miss it completely. And what's going to go through the roof are the resource shares. They are technically the most undervalued at the moment. So you will see Anglo American back in 350 without blinking. You'll see Billiton back at 300 and so on. So you need to have a portion of that in your portfolio. The other or the third scenario is that we're just going to muddle along. You know, we're just
which we have been doing
which we have been doing, and who's to say we can't continue in this pattern? If you can get past the day-to-day volatility and you actually look at the undercurrent market, there are still good potential options out there. Companies are still making money, they are still growing, they're still hiring people. So if you have a good selection, a good diversification, you've got some resource stocks, you've got some good retailers, maybe a bank or so, and so on and so forth, then I think you would be okay. In my opinion, you need to have a balance. It's always proved successful in the long term.
Let's take your scenario of things sorting themselves out and suddenly there's a rush. Obviously we would be pulled along with that.
Definitely.
But there would be other things perhaps pulling us back. We had our manufacturing confidence index very low. The manufacturing business confidence in the manufacturing sector, low confidence.
Absolutely. Well, look, I mean, that's very difficult, and a lot of it, in my opinion, is politically driven and needs to be sorted out through that perspective. But a lot of South African companies are getting around that. You need to understand South African companies, at least part of the top 40, are far more international than they've ever been before. And regardless of manufacturing in South Africa and confidence and the mining sector output, it doesn't, in my opinion, affect the scenario of those companies specifically. So that's those are the kind of companies that we would want to have on the portfolios and want to invest in. I mean, obviously you would want the manufacturing numbers up, you would want the mining output numbers up, but that's not going to happen overnight. That's a structural issue. It's going to take many years to sort themselves out. South African companies realize this, and a lot of them have been going offshore 5, 10 years ago even. So it's those companies that you want to be interested in, because it's not a local issue, it's an international investment horizon that you should be looking at the end of the day. So that's what I would consider those companies to be involved in.
Let's look at the telecom sector, these giant companies like MTN, 0.5% down today. We saw now the market clearly is not reacting anymore to news from Turkcell or the court case and things like that. It's a big company with a big reputation. What risk there is must have been priced in by now.
It's a very good point. It's a very good question you ask. Look, it's South Africa's 4th biggest company. It's underperformed the market the last 3 years. And you've got MTN and Vodacom, which are the 2 big listed companies out. Then the toss-up is, which one do I buy? Do I have both in my portfolio? Do I have the one or the other? All right. Now, if you look at MTN, there's absolutely no doubt the market consensus is a much, much higher share price than where it is now. If you look at a lot of the South African unit trusts, it's some of their top holdings. So there's definite value there. What you have is you have an overhang of the Iranian issue. You have the Turkcell issue. Then you have the Nigerian issue as well. And it kind of comes with the territory. You need to understand that as an investor. Because MTN is invested in emerging markets, you're going to have that geopolitical risk.
Well, you understand that because they want big markets and big rewards if they get it right.
So MTN is in the right space with regards to telecoms growth, but they're in difficult areas, and that is having a sentiment-driven negativity to the share price, and that is why the share price has underperformed. Okay. If you're looking at Vodacom, on the other hand, it's in a very developed market, South Africa, and generally South Africa is geopolitically safe in the greater scheme of things. All right. So Vodacom is the lower risk option. Both are going to give you good income returns because both have become very good dividend payers. Vodacom slightly higher than MTN. All right. Vodacom over the long term will also give you capital growth, but as soon as this Turkcell issue is sorted out, or as soon as the Iranian issue is sorted out, you're going to see MTN fly far higher than what Vodacom is. So if you are looking for a lower risk entry point, Vodacom's a brilliant buy. If you're looking for a slightly higher risk, MTN's a good option. It's not bad actually having both on the portfolio. They give you great dividend yields.
Seeing that we're talking telecoms, final point on Telkom, 2 views there. The one is that you don't go near it because it's cursed and doomed forever by the government overhang.
Yes.
The other is that it's still going to be there, lots of infrastructure, and it's quite cheap at the moment.
Yeah, I've got a lot of clients asking me that. I think, again, because of where we are in the world and there's just so many unknowns, I'd rather be buying into companies where I feel more security, you know, where I know what's going to happen. Telkom, you can take a punt on. Absolutely, it is at 21 Rand. It's at an all-time low. But again, I would rather buy a Vodacom, for example, in these markets.
Well, that was Nicholas Sorour, who is portfolio manager at Sasfin Securities.